If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, it's Tortoise Investing coming at you today with 5 more dividend stocks that you can buy and hold forever. Got 5 strong ones. I like all of these, to be honest. Now, if you are new, please hit that subscribe button. Join the 556 that have already done so. I greatly appreciate any and all support. Drop a like down below. All those things are super free and easy to do. And as always, do your own research and stuff before buying stocks. None of these are just guaranteed to go through the roof. Just have to put that disclaimer out there. Not financial advice. Now, what are we going to be taking a look at? We got ASML, Lockheed Martin, Hershey Company, PepsiCo, and Texas Roadhouse. I am recording this on Tuesday. This is going to be coming out on Wednesday. I got a long work day ahead of me tomorrow, but getting a little bit of a jump on my recordings. Now, ASML, adjusted free cash flow yield of 2.15%, dividend yield of 1.16%, payout ratio of 22%. Now, the reason I've got my eye on this, it's off a recent high of $754 as of July 17th. It's down about $90, and I'm sitting here, I'm looking at the metrics and everything, and I'm like, well, this thing looks pretty good. It's got a revenue growth over the last 10 years, 16%. Very nice. Free adjusted cash flow, 30% over the last 10 years. Look at that. It's just accelerated. EPS growing at a rate of 18% over the last 10 years. Very nice. They have more cash than debt. I love that. I can't stress enough how much I love that. Their debt's $3.5 billion. Their EBITDA is $8.2 billion. So they could just pay this off of their EBITDA and have a lot left over. Pay this off with the cash, have a lot left over. I like companies that, like, their issue is they have more money than they know what to do with. I like that. I like that a lot. The dividend, not really any growth. This is the one thing it kind of like I scratch my head at. It fluctuates up and down all around, but it's been like consistently above like $1.30. So I mean, it's not a growing dividend, but this is definitely a growing company. Over the last 10 years, up 649%. So yeah, and they're off a recent high of let's see here, right at $890, September 15th, 2021. Down to $663 right now. I really like this company. I just, all of this right here just screams yes to me. Except for that screams what? So shares outstanding. They have been doing share buybacks. Just another check mark right there. Over the last 5 years, 1.61%. Over the last year, 3%. Just shares getting bought back. I love that. I love a company that does share buybacks, especially one that's got bunch of cash on hand, growing EPS, growing revenue, free cash flow. The return on capital employed is 37% 2021, 34.7% 2022. This is growing. I like them. I like them a lot. Next up, we got Lockheed Martin. This is another one I've got my eyeball on. Just a free cash flow yield of 5.11%. It's got a dividend yield of 2.68%, payout ratio of 43%. Now, revenue's been increasing. That's throwing things off. Was increasing at a rate. Let me see if I can just kind of. Yeah, as you can see here, let me just show you this real quick. Quarterly. So they've reported 2 quarters this year of revenue growth, and Qualterm's only showing one of them right now, but that's okay. Ignore this for now. So this is growing. The free cash flow is also growing at a rate of 25% over the last 10 years. That's what I'm talking about right there. EPS, same situation. It is growing. Again, that's going to be throwing things off a little bit here. They reported 6.61 in March, 6.63 in June. So really, this should be about 13 in a little bit. So Yeah, they're on track for beating last year's EPS because they're at 13 right now. They've reported 2 quarters. With that average, they're going to be reporting around 24, 26. So I like it. It's going to be a growing EPS. Debt, they have 15.4 billion. Their EBITDA, again, this is kind of throwing things off. 8.71 billion when that was recorded. My general rule of thumb is I don't like companies to have 3 times more than their EBITDA in debt. So this was 8.7, and this was 15. So let's just say if this was 27, it would be more than 3 times, and I'd be like, well, you're getting a little bit too much debt there. But they've got it under control. The dividend's been increased at a rate of 10% over the last 10 years, 8.45% over the last 5 years, and they are due for another hike. So I'm thinking it's going to probably be about $3.24 if I was to throw out a number, because I think that's about a 7.5% hike. So I could see them doing that easily. They've been getting contracts left and right. They've been winning so many contracts through the government for all the everythings that they do. It's such a strong company. Let's take a look here. Oh my God, they've been buying back shares so hard. I like that. Over the last 10 years, 2.47%. Over the last 1 year, 7.82%. They are demolishing that share count. What is that? 20 million shares bought back in the last year? Oh my goodness. Yes, that is what I want to see. Return on capital employed has been reliably above 23, 24 area for a while, right? Last year it was 22.5. So in the lower 20s is usually where their return on capital employed stays. So again, very strong metrics. I didn't know. This is new. This has been updated recently. It makes me like them that much more. Next up, Hershey Company got adjusted free cash flow yield of 3.64%, dividend yield 2.23%, and a payout ratio of 47.7%. This is one I personally hold, and I am looking forward to buying even more of it on this dip. They are off their recent high of $275, so down a good bit. And I like it. I like where it is currently sitting. Revenue's been increasing. I read 6.75% over the last 5 years. The free cash flow has been increasing at a rate of 12.76% over the last 5 years. It is accelerating from their 10-year. The EPS 16.69% growth over the last 5 years. Very nice. They have a little bit of debt, $3 billion in debt. Their EBITDA is $2 billion. No issues there whatsoever. The dividend's been increased at a rate of 9.41% over the last 10 years. Their last hike looks like it was a pretty big one too, from $1.04 to $1.19. Looks like a 15% increase. Very nice. I like that a lot. When it comes to shares outstanding, they don't really buy back their shares all that much. I wish that they would, but I'm not going to complain. I really like the company. Return on capital employed. In 2020, it was 19, 2021, 20.3, and 2022, 21.8. So the return on capital employed is growing, revenue is growing, cash flow is growing, dividends growing. I like it. Next up, we got PepsiCo. PepsiCo, free adjusted cash flow yield 2.22%. Got a dividend yield of 2.73%, and a payout ratio a little bit on the high side of 82%. But I think they'll be fine. I think that they will be fine. I don't see this dividend being in any troubles whatsoever. They are off their recent high of, let's see here, 196 down to 174. So they're down over $20 off their recent high. Revenue's been increased at a rate of 6.34% over the last 5 years. It looks like they are increasing with their growth, 10.8% over the last 2 years. The free cash flow, let's see here, hasn't really been growing. It's kind of like plateaued in this area of around 5 to 7 billion, which is still pretty strong. They've been around for a while, so EPS been increasing at a rate of 13.69% over the last 5 years. Very nice. Their debt, they have $35 billion in debt. Their EBITDA is $14.77 billion. So again, that falls right in line with my rule of thumb. Not an issue. They could pay this off easily within 2.5 years. Dividend's been increasing at a rate of 8.34% over the last 10 years. Their last hike was over 10%, so that's very nice. Very, very nice. Get some compounding going on there. The shares outstanding, they have been buying them back at a rate of 1.26% over the last 10 years, but it looks like they have slowed down with their share buybacks. And the reason being is the stock costs more now. It's selling at a bit higher than what it historically has, but that's because they are just pumping out some monies. Like I said, the revenue's been increasing at a rate of 6% over the last 5 years, 10% over the last 2 years. So the share price is indeed following suit. Return on capital employed, 2020, 14.49, 2021, 16.8, and 2022, 17.6. And lastly, we got Texas Roadhouse, an adjusted free cash flow yield of 2.52%, dividend yield of 2%, and a payout ratio of 46.33%. This is another one I hold and another one I'm looking to add on dips. Revenue's been increasing at a rate of 12.26% over the last 10 years. That's just straight up and to the right. Free cash flow, up and to the right, 15.84% over the last 10 years. They are off their recent high of 117. So they are down about $15 off their recent high, and that's the reason I started looking at them. EPS been increasing at a rate of 14.78% over the last 10 years. They had their little 2020 COVID dip. A lot of things did. The thing that I love about this company, they usually always have more cash than debt. And that is just how they've operated forever. They've got $50 million in debt. Their EBITDA is $460 million. That's not an issue with this company at all. The dividend's been increasing at a rate of 16.44% over the last 10 years. This is just a set of stairs. I love it. Great compounding. Comes to shares outstanding. Over the last year, 3%. They've been buying back a little bit of shares. Let's see here. Yeah, a little over 2 million shares. I like that. I like that a lot. Take opportunity because it did dip into like the 70s last year. So it looks like hopefully that's when they were buying back their shares. Because you want the company to be buying back cheap shares. And the return on capital employed, 13% 2019. They had their 2020 hiccup. 15.56% in 2021 and 17% in 2022. So yeah, 5 strong dividend companies. I feel personally, again, do your own research before buying anything. Definitely got my eyes on some of these. But yeah, hope you've enjoyed that. Make sure to hit that like and subscribe button for more. And until next time, see you.